morning. How's everybody doing today? We are getting started here on our first lab of the new semester. So very happy to have everybody here. Well, it looks like we got a nice little crowd here started first thing in the morning. Glad to have you. Get your warm cup of tea, and we're just going to sit back. And today we're going to kind of have the lab, a little bit of a review of the things that we talked about in class last night. And so we're going to talk a little bit about the exchanges. We're going to talk about some brokerage firms. We're going to talk about the stock market and the stocks themselves, primarily ETFs, exchange traded funds. And that's kind of what we covered last night. So I just want to go through and practice what we preach. And this is the little marquee that we started with right here on the YouTube channel, right? So stock market for beginners, getting started. So the first thing we need to know when we start to trade the stock market is we need to have access to the market. How do we get access to the market? Now, remember, there's exchanges, and the exchanges are where the stocks are all traded. Now, we as small speculators, as small traders, we don't get to go to the exchange and just start trading. We have to have somewhere that we start, and we generally start with a broker. All right. So we have to have a representative that represents us to the exchange. And so that's a broker. And there's a number of different brokers out there, as we talked about last night. You know, there's great big brokers like Goldman Sachs and Merrill Lynch and JP Morgan Chase, great big huge brokers like that. And then there's smaller brokers, there's littler brokers. All right. And we talked about several brokers that you can get involved in. And the one, that I prefer, obviously, is the one that's tied to the software that we use, which is called Tradeer. All right. So Tradeer is actually the clearing firm, kind of the brokerage clearing firm. We're going to use Track and Trade. That's the one I use. And then, of course, you can also use, we talked about a small one that just works on your little iPhone called Robinhood. And so you can use either one of those two. Robinhood is free for people who just kind of want free stuff to start off very small, easy, and simple. You can use Robinhood. And Robinhood's not bad. There's lots of brokers you can choose from. If you've already got a broker, you don't need to switch. I'm just telling you that this little Robinhood app on your phone is a pretty good one that you can use. All right. And it's very simple and easy, and it's free. And so I try to give people multiple choices when I'm teaching. You can use free, and we're going to show you another free charting application, or you can use a little bit more sophisticated application that's not free. All right. So the one I use obviously is not free. It's the one that we created. It's called Track and Trade. It's won Stocks and Commodities Annual Reader's Choice Award 7 times. That's this platform here, and it's all encompassing. All right. You send your money into the company that's associated with Track and Trade. That company or that clearing firm is called Tradeer, and then they're going to be your broker. And then you got Track and Trade, the company, which is called Gecko Software. They're the ones who develop the software, write the software, support the software. You're dealing with a software engineering firm as opposed to a brokerage firm. All right. So here is just a little link for you here, just real quick.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so that's the software that we're going to be using if you want to pay for software and have the advanced capabilities. If you still kind of in that world of I just want free, then I've got another package for you, and we use this one too. And again, there's lots and lots of tools that you can use out on the internet. There's lots of free charts. There's lots of free stuff. You can look and look and look and play and play and play as long as you want. I'm just telling you my experience, okay? I'm not here to tell you what to do. I'm just telling you what I do. And I think that that's a better way to teach than anything. Just say, hey, this is what I do, and you can go do what you want. I've been doing this for 40 years. I've looked at everything that's out there. You can go look yourself if you want, or you can just take the shortcut and say, well, that guy's been doing it for 40 years, and he says this is a great little tool. It's free. I'll just use that free little tool. All right. So this is the one I like. And if you want my help, which is why I'm here, right? I mean, I'm the teacher at the university, and that's why I go down there, so I can help you. And that's why I'm teaching this class right here, is I'm helping you. If you want my help, use the tools I use, and then I can more easily help you. If you go off and start using weird ass tools that I have no idea what they are, and then you come to me and say, how do I do this? I don't know. I don't know. You're going to have to figure that one out on your own because you're not using the tool that I know how to use. So again, one of the only reasons you might want to use the tools that I use is so that I can help you, and I'm here to help. So if you want my help, it's easier for me to help you if you use the tools I use. And this little FinViz is, yeah, it kind of sucks, but it's free. Hey, and if you want free, you're going to have to, sacrifice a few features. Okay, but it's not bad. It's the best one that sucks. It's the best free one out there, in my opinion. So this is the one we use, and it's very simple. Now, remember last night when you learned about the stock market, each stock company has its own symbol, and the symbol is generally very closely associated with the name of the company. So, for example, if we come down here in this little corner, you can see they have what they call a heat map. All right, we have a heat map in here. And the heat map, you can see, has a lot of the symbols in it. So you can see right here, NVIDIA, NVDA. That's the name of their ticker symbol, and that's their company. Here's MSFT. That means Microsoft, so Microsoft is represented there. Here's Apple, AAPL. All right, so if you want to look at Apple, the price of Apple, and that's really what we're doing. We're just looking at the price of what it costs to buy a share of stock in that company. And the prices of the shares of stock change over time. And so the name of the game is to buy low and sell high, right? So you buy into the stock, and then you hopefully over a period of time it goes up, and you can sell it, and you can sell it for more than you bought it for. Just like any retail store. You go out, you go to the manufacturer, you buy a toy, you put it on your shelf, you bought it for $10, somebody comes in, buys it for $20, you made money. We're going to do the exact same thing, only we're going to do it in the stock market so that we don't have to deal with shipping and manufacturing and employees and telephones and renting space and doing all that stuff. We're going to start using the stock market like a business. So I want you to start thinking about it like a business. All right. I remember last night I talked to you about I'm going to change your mind. And what I'm going to do is I've got to introduce you to the stock market. This is the introductory class for brand new people. So we're going to get introduced to the stock market. We're going to start discovering the tools, getting comfortable with them, using them, figuring out how to navigate through the tools. And then I also want to change your mind. I want to make you start thinking like a investor or like a business person as opposed to a trader or an investor. So I got to teach you how to be an investor or trader, or what the kind of standard normal ways of doing things. And then as we move through this semester, I'm going to slowly switch you from being a trader into a business person. All right. Because I want you to be a business person in the stock market. I don't want you to be a trader speculator. I want you to run this trading thing that we're going to be doing like a business. Okay. And it's all in your head. And it's all how you handle things. And it's the decisions, it's the way you make decisions in the market will be different than somebody who is just a speculator or a trader or an investor. We're going to operate as a business. Okay. And we're going to talk about that in greater and greater detail as we move along. I just want you to get comfortable and familiar with the tools that we use to run our new business. Okay. And it can be any size you want. If you got $10 and you want to start your business with $10, that's perfectly fine, because everything we do is based on percentages. Okay. We do everything on percentages. So somebody who has $1 million portfolio, they can be up 10%. Somebody who has a $10 portfolio, they can be up 10% as well. And there's no difference between the two. You do the same thing between them. Well, if you have $1 million portfolio, we might do a little bit different than if you have a $10 portfolio. Okay, let's be honest. All right, but nonetheless, the rise in price should be done in a percent basis. So today is just getting familiar with the tools. All right. So I just want to point you in the direction of the tools. I want you to go play with them. I want you to get familiar with them. I want you to start looking around and seeing what you can find on these different tools. So this is the free one. We'll start off here with the free one, and then we'll go over to the paid one, and you can see why there's such a difference between the two. Okay. So the first thing we're going to do, as you can see up here on the top, there's a little box up there. It's called the search ticker company. So if you want to see the price of a particular stock, you put your symbol in there, you put your little cursor in there, and you just type the symbol. So let's start off with Apple, and the Apple symbol is AAPL. Now you can type in Apple, you can say I want APLE, and it'll pull up the Apple company, but there's more than one Apple company. See that Apple, APLE, it's going to look for the little search term, and then it's going to be Apple Has Hospitality REIT. And that's not what you want. You want Apple, the company that sells iPhones. So you have to be a little bit more strategic about it. So now if you type in Apple, A-P-P-L-E, now you get a list of Apple companies. Now there's Apple, there's Apple Hospitality, and there's Apple Inc., and you can choose whichever one you want. So if you don't know the symbol, you can just type in the company name. So for example, we can type in Microsoft, and it'll pull up the Microsoft symbol. See how it does that? Pretty simple, pretty easy stuff. So we're going to come in, let's pull up Microsoft since we got it. You just click on it, and it's going to switch over, and it's going to pull up the price chart for Microsoft. And that's it. That's the price chart for Microsoft. So you can see down here along the bottom is the date. Now, this is what we call a daily chart. Okay, so you see right here across the top, we got 1 minute charts, we got 3 minute charts, we got 5 minute charts, 15 minutes, 30 minutes, 1 hour, daily, weekly, monthly. That's what that means. And so we're looking at the daily, which is the most popular and the most common chart for individual investors who are trading for a long period of time. Mostly what we would consider somebody who's trading for retirement, right? You're going to come in and look at the daily, maybe even the weekly, if you're looking at years and years in past. But for us, we're just looking at the daily chart. And what that means is that each one of these little bars right here, see these little price bars? Each price bar represents that day's open, high, low, close price of the individual stock, Microsoft in this case, and how much their stock changed during that day. So each price bar in here represents 1 day. Now I've got special price charts in here, and I'm going to go in to my settings, and I'm going to show you, this is the settings, and you can see my settings over here for the free charts. I've got something in here called where did they go? Fibonacci bars. See chart type right there? It's called Fibonacci. So we're going to come in here and we're going to go to the open, high, low, close, or we can go to candlesticks. I'm just going to go to standard candlesticks. And this is very popular, very common to just have normal candlesticks. Let's see. Candlesticks, I got to save the changes. So now this little application is going to open up my charts with just normal candlesticks. This is the most common means of looking at a chart with just normal candlesticks. I like a special kind of candlestick called Fibonacci, and we'll look at those over in the paid software program. So that's how you find Microsoft over here. And all you're going to do is look at the price, and you say, well, hey, look right here and you can see the date down at the bottom. Well, kind of. Sometimes you can see the date. You can't really see the date. There it is. October up here in the left-hand corner. That little high peak right up in there, you can see that on that date, the price was $546 for 1 share of Microsoft. 1 share of Microsoft. But today, it's trading for $449 a share. You see over here on this right-hand side, you can see that little orange ticker right there is telling you how much it's trading for today. So it's trading for $449. So if you would have bought it on this day, $547, and you still owned it, well, you'd be losing money, right? Because you bought it high, you bought it for $500, and it's now trading at $449. So you'd be losing money. All right. So the name of the game is to buy low and sell high. You want to sell your toys that you're buying for a higher price than what you bought them for. It doesn't make any sense to go buy a toy for $10, put it on the shelf and sell it for $5. You're not going to be in business very long. Same thing in the stock market. Buy low, sell high. But Lan, how do you know when it's high and how do you know when it's low? We got classes for that, and they're coming up. So stick with us. We're going to teach you a lot of that kind of stuff, all right? Because that's very important. It's what we call decision point trading or technical analysis, where we analyze markets from mathematical standpoints, and we determine when markets are expensive, when they're overbought, what we call overbought, all right? Or when they're cheap, when they're dear or cheap, all right? We want to buy things when they're cheap and sell them when they're dear. So this is just a price chart, and that's all it's showing you. It's just showing you the price of the chart of Apple over the last year's period of time. Each one of the little price bars represents 1 day's open, high, low, close for the day. What did the price open at? How high did it go for the day? How low did it go to the day? And where did it close at the day? All right. And then we go on to the next day, and then we go on to the next day. And each day, the market prices change every day. Some people like to go in and trade down on what we call a 1 minute chart, like way down here to the bottom, and you can trade by the minute. Okay. And you can come in, and if the market goes up a little bit, you make a little bit of money. If it goes down, you lose a little bit of money, and you can trade just by the day. That's called day trading. That's very popular, very common, and you can do that. All right, can't do it here. This just shows, this is just a picture of price. This isn't a trading platform. You can't actually trade here. You can't actually make or lose money here. This is just an image of what price is. All right, it's just a little free website that shows you the current price, and it's 20 minutes delayed right now. It's not even showing you the current price. All right, so now we're going to come over and we're going to come back and we'll look at another stock. Let's come back up here and we'll look at Apple. So we're going to type in AAPL and we pull that one up, and there's the price of Apple. All right, so that's the 1 minute chart. We're going to go back out to the daily chart, and you can see this is what we were talking about yesterday. I got a few drawings on here I'm going to delete. And you can see that we were talking about this one yesterday in class, how much Apple fell yesterday. Big drop in Apple, right, recently. And so we talked a little bit about Apple. I also talked a little bit about Apple and maybe some of the shares that they're buying back and some of that. If you purchase this FinViz, it shows you some of that down here. All right. So it shows you that the sales of Apple have been flat for the last 1, 2, 3, 4, basically last 5 years. They haven't really made any money, any more than what they usually make. They're not a growth company like they claim to be. And see this little thing right here? This shows that they've been buying their shares back, and they haven't been able to buy them back fast enough to keep them up in the air. They just keep buying them back, trying to prop up their stock because they're not making any money. So unfortunately, Apple is playing some nasty games behind the scenes because they're not doing well. All right, Apple is not doing well. That's what this shows you down here. Their earnings per share went way up. Look at that. Oh, earnings per share. They're making lots of money. Well, no, they're not. They're buying their shares back, so they got fewer shares to put the same profit against. So now it looks like their earnings per share went up. So it's a falsehood. It's based on false premise, and that's what this shows you down here. You can derive that from looking at these little charts. Now, you don't get all these little charts unless you pay for them. You have to pay for this service to get those little charts. And I pay for this service, and that's why I got those little charts. So if you don't want to pay for the service and you want to see those little blue charts, just come here to class and say, hey, Lan, show me the little blue charts for whatever stock, and I'll pull them up and show them to you. All right, and we'll talk about them. That's why you have me, if you don't want to pay the money. Or you can just pay the money and do it yourself. All right, that's probably better anyway, really, in the long run, right? But you can use me in the beginning. All right, now that is the free little charting application that you can use if you just want free. Now, if you want to do it a little bit more professionally, I'm going to recommend this charting application. And the reason I like this one is because it has 1,000 times more capabilities, but oftentimes 1,000 times more capabilities oftentimes comes with it a little bit more complication, right? It gets a little bit more complicated when you got more things you can do. If you can only do 2 things, well, it's not very complicated. I'm going to do this one or that one. But you got 500 things you can do. Oh, which one of these 500 things am I going to do, right? So this one is a little bit more powerful. That's why you pay for it. But it's got lots of capabilities that you're going to need as you start building your own little portfolio, all right? And the great thing about this one is this is also your brokerage firm. So you trade through here. So you have a trading tab right here. You just come over here, and if you say, oh, I want to buy this is the S&P 500. We talked about the S&P 500 last night, right? The S&P 500 is what we call an ETF, an exchange traded fund. And so it's a conglomerate or 500 different stocks all put into one basket. And so we track that entire basket of stocks with one chart. We don't have to go out and look at all 500 stocks and say, I want to build myself a portfolio full of 500 stocks so I can have a good smattering of the entire stock market and go start buying 500 stocks in your portfolio. They've made it very simple for you, and they called it an ETF or an exchange traded fund. And you just come here and you buy just this one stock, and then you'll have ownership in 500 different stocks. Now, remember, they don't do it equally. They don't just say, okay, you have equal distribution across 500 stocks. They kind of weight them, and they say, we like this one more, and we like that one a little bit less, and we like this one a little bit more than that one. And they kind of put a little bit more money in different ones, and they have different sectors, all right? What we call sectors. So we have utilities, we have technology sector, and they have all these different sectors, and they'll break down the S&P 500 into different ETF sectors, and you can invest in just those sectors. Believe it or not, it's very cool. And we'll talk a little bit about that here in just a minute. So you want to come in, let's say that in this program, you want to buy the SPY. It's very simple. You just come in here and say, I want to buy 1 share of the S&P, and you hit buy market just like that, and you now have 1 share of the S&P 500. That's all there is to it in this program. Now, if you have the other program, you can't do that because it's not a trading platform, all right? It's just a website, and you can't buy and sell stocks on it. So you have to have the little free Robinhood program to buy and sell stocks. That's why I'm telling you how you can do it for free. You get the little Robinhood program. I gave you the little link to it last night in class, and you can go and you can open up you can give Robinhood your money, and then you can look on the FinViz website and you can say, oh, I want to buy some S&P. I want to buy one S&P. And so then you come over to your little phone and you go bang, 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 bang. And you hit all the right buttons in their program and you get to buy one share of S&P. All right. So that's how you do it. If you're going to do it for free, it's a little bit more complicated because you have to deal with more programs and all that kind of stuff. But even the little app on your phone will have little tiny charts that you can look at, and you can see what the price of the stock is. All right. So that's one way you can do it, or you can do it a little bit fancier way. You can just do it right through this software. To open up a real money account, there's a little link right up in here. Let me try and make this bigger. I'm always in the way, but I'm not in the way in this one. Let's see. There we go. So up here in the upper left-hand corner, you can see that you got a open real money account. You click that, and it's going to take you over to a website that's going to have you set up your real money account, and you just fill in your information. And unfortunately, it's way too easy. All they do is ask you for your information and tell you where to send money. So that's all there is to it. And you get this, and then suddenly you can have your money will show up over here in your account, and you just sit here and trade right here, and you do everything in this one program. That's what's really nice about having a trading platform. Now, there are other trading platforms as well that do the same thing, okay? So you can get other trading platforms. I'm just telling you, once again, this is the one I use. And so if you want my help, I will help you if you have this one. If you go off and get some TD Ameritrade or some Goldman Sachs or some other program, I don't know how to use those programs. I can guess, but I'm not going to be much help. I can sit there and say, hey, we're going to buy the S&P. Here's how you do it. You come over here and you hit this button right here. Now we got two S&Ps. That's how you do it in this program, but you're going to have to go figure out how to do it in your program on your own. I can't help you, all right? Because I can't sit and teach every program, because there's hundreds of programs that you could use, and whichever one you choose is the one you want. And that's perfectly fine with me. I don't really care what you do. I'm just going to show you what I do. All right. And so what I do in these classes is use these programs. And if you want my help, I'll help you, because I like to help people. That's what I'm here for. All right. So now we have some different ways of looking at the charts. Now I'm going to come in here and I'm going to turn off the Fibonacci just like we did in the last one. This is what, and I'm going to exit the charts. So I'm going to exit off, and we don't want our S&Ps anymore. And I'm going to turn off some of these indicators down here just so that we can get a simple, very simple look, just like what most normal people out there who are trading are seeing. All right. I'm going to even turn this off. Let's actually even turn this off. We're going to come down here and we'll just turn on what most people are looking at when they start trading. This is pretty typical stuff right here. This is just a normal, typical chart of price with no fancy mathematical models going on over the top of it. And this is volume down here. This tells you how many participants there are trading that day. So you can see over here during this little spot back here, this happened to be back in April of 2025. Lots of people were trading. All right. That got really crazy during that week time frame. You can see all the volume down here. This is how many people are buying and selling. And it's green because there are more people buying than selling. That's why it's green. And this one here is red because there's more people selling than buying. That's how that works. All right. Now, it's not really like that, because there's the exact same amount of people buying and selling as there are selling, because this is a 1-to-1 ratio market. For every buyer, there's got to be a seller. So when you look at this and it says it's red, it doesn't really mean that there are more sellers. It just means that the market was going down a lot more. So it was more people were trying to sell, but there's still got to be buyers to buy. Otherwise, the people can't sell, right? It's got to be buyers and sellers. So really what you're looking at here with this red bar is that the bar up here is going to be probably red because it's closing lower than its opening, meaning that people are selling out. So the price is going down. Okay. So I know it gets a little bit, sometimes you start going, wait a second, what? Don't worry about it. It'll come to you. You just keep thinking about it like that. Just think, well, more people are selling than buying. They're not really more people selling than buying. It's just that the people who are selling it, and people who are buying it, it's pushing the market down. All right. And so you've got what we call the spread and the bid and the ask. And I'm not going to get into all of that right now, but that's how markets move up and down. Just know that if the market bar up here is red, it's going to probably be red down here. All right. Just means that lots of people are selling out and the market's going down, and we're getting lots of down volume on the bars down there. Okay. So that's what that's telling you down there. And we oftentimes look at this to see whether, it's a good time to trade or not, because it's like, oh, lots of people are trading and we can do different types of things. Options are very reliant on how many people are trading. So we do a lot of options. We look at volume on options, but options, don't think about that right now. We'll push that out into the future. That's the very last class we teach in the seminar. All right. In the semester. So we'll get to options. They're really super cool, and you'll definitely want to do it if you have any interest in the stock market. But right now, let's start off a little bit cleaner and a little bit easier. All right, so let's come back over here to the charting tab. And you can see in this software, we have a whole list of all the different charts that I've opened up, create what we call a portfolio. All right, so I can come in here and I want a new portfolio, and I can just give it a name. I'm just going to call it, this is our YouTube portfolio. Class 1, and we'll say okay, and we're going to open up a few stocks. All right, we got some that we might want to look at. If we want to look up our YouTube portfolio class, we're going to look at AAPL because we like Apple, and this software is just the same as the other one. If you don't know the name of the stock but you know the name of the company, you can just type the company name in there. So we can type in Microsoft, and it pulls up a little search screen and says, hey, here's what we found in Microsoft. Is it one of these that you want? Oh yeah, it's right there, Microsoft. You click on it like this and hit OK, and it opens up the Microsoft stock just like that. Okay. Now Microsoft's not doing very good, right? They're falling like a terrible. So a lot of these big stocks, they're come tumbling down. Look at this. This went way up, right? Everybody's like, oh, stock market's really good, but what goes up must come down. Not always, but usually always. The stock, what goes up must come down. And so that's why we buy and sell. If you just buy and hold, well, if you'd have bought it right here, right, and said, well, I'm just going to hold it till I'm 60 years old, right, and then suddenly it's right back down here. You held it for a whole year and didn't make any money. So oftentimes, to show an increase in money, you have to kind of buy and sell sometimes. Well, otherwise, you made a whole bunch of money, but then you just gave it all back. Well, it'll come back. Yeah, but time is expensive. Time's value. Time is money. This is where time becomes money right here. This is the place. This is where that term came from. Time is money. Well, it'll come back. It'll eventually go back up, and I'll just wait another 6 years to get my money back from where it was and what I had. I had this much. I'll wait 5 more years, and it'll come back up to where it was, and I'll have it again. Okay, if that's the way you want to do it, that's one way of doing it. I like to take profits along the way. For me, I like to take money out of the market along the way. If I just constantly putting money in, well, I have to deal with having to do this type of thing where it goes way up and I make a whole bunch of money and then I lose it all. And then I have to wait 5 years for it to come back up again, or 2 or 3 years for it to come back up again, just to get back to where I was. All right. And in those 2 or 3 years, I could have had here, right? So there's different ways you can play it. And that's what we're going to learn in this class. We're going to learn strategies. And so the series of classes that we're going to take all the way from this introductory class, the next class that starts next week, which is Monday, Wednesday, and Friday, we're going to start getting into different ways of taking profits along the way. We're going to talk about different ETFs and different ways of making money in the stock market, because there's lots of ways of making money in the stock market. There's only the most popular way, the most common way, the people that most people think about is they just say, well, I just buy and hold. I buy it, and in 30 years, I'll sell it, and then I'll be rich beyond my wildest dreams. But what if that's not what happens? What if you buy it here, and then in 30 years, you sell it here? Well, you waited 30 years. You didn't make anything. You made a lot, right? And then 30 years later, you didn't make it. It's all gone. And maybe you bought it here and pretend like this is 30 years. 30 years later, it's here. You didn't only make money, you lost money for 30 years. All right. Now, generally speaking, if we go back, let's go look at the S&P 500. The S&P 500 is a representation of, basically, you can think about it as the U.S. economy over a long period of time. So this is what the U.S. economy has been doing over the last year. It's just been going straight up, like almost like we've never seen before, right? Amazing, crazy market. So we can go back and we can go look back further. We can make each price bar look like a week, right? Or we can make each price bar a month. So each price bar is now a month. And so if you say, well, I'm just going to buy, and in 30 years, the market will be way up there. Well, traditionally speaking, that's true. That would have happened, all right? Because if you would have bought back here, which is back in 2012, and then you have it right here. This is where, you'd have been making a lot of money. So you could go from here all the way up here with 100 shares. If you'd have bought 100 shares back here on November 1st, 2012, and then what would you be valued at right here with 100 shares? 100 shares back here would have cost you $14,000. This would now be worth, your $14,000 would be now worth $52,000. You'd have gone up 344% in value. That's pretty cool, right? So over the period of time, that's a long period of time, but that's how it works. If you just kind of put your money in for a long period of time and hold it. But the problem with a lot of us getting a little long in the tooth like me, right? The best time to start investing was 30 years ago. The second best time to start investing is today. So, you got to take it all with a grain of salt. Some of us don't have 30 years to wait, so we can't play the 30-year long game. We need to start taking money out of the markets now. We need to make an income. Some of you want to make an income out of the stock market. Some of you may have a job where you're just not making ends meet. And you're like, man, wouldn't it be really nice to have an extra $300, $400, $500 a month that I could use, rather than saying, well, I'm going to do this for 30 years. It's not very exciting to have me come in and say, well, just start putting your money into the S&P 500 and in 30 years you can start taking some out. Now, for some of you young kids, we might say that to you. You start putting some money into the market and just doing it for the long haul, and you can just set that money aside and just put a little bit in there all the time. And in 30 years, when you're ready to die, which you don't think you're going to ever do, but believe me, it comes really fast. It was just yesterday I was 15 years old, and today I'm 62. How about that? I don't know how it happens, but it does, believe it or not. So you really do want to plan for the future, because the future really does come. Even though all the people out there are telling you that there is no future, there actually is, and it actually does come. And it's going to come for you. And you're going to be here, believe me, trust me, you'll be here in 30 years, and you'll be saying, man, I wish that school teacher I had back when I was 15 years old, I would have listened to him and I'd have put some money into Microsoft stock, or at least into the S&P 500, right? So we need to plan for the future, but a lot of us don't have much of a future. Don't want to put it that way, but we're a little bit older, right? So we want to actually use the stock market as a place to make money, not just to save money. So rather than constantly putting money in for 30 years, we're at the age we want to start pulling money out. But you're like, yeah, but Lan, I didn't put it in 30 years ago, so I don't have anything to pull out. I got you. I got you covered. That's what we're going to be talking about in the next classes, how we're going to do that. How do you pull money out of a market when you didn't put any money in? Well, it does take money to make money. All right. But we're not going to have to wait 30 years. And I'm going to teach you how to do that. The rules of the stock market have changed in the last couple of years. And there's some really cool things that they allow us to do now that allows us to take money out. I call it UBI, Universal Basic Income. And so if we set up our thought process, right, if we start thinking about the stock market in a different way, and we start thinking about it like a business instead of like a long-term investment, a retirement account, we can now start taking money out of the stock market just like we would a business, just like we might if we had a toy store. We buy low, sell high, but we're going to do a little bit different even than that. With these new rules, I'm going to help you understand how we can start taking money out of the markets. And it does take a little bit of money to start. You're going to have a little bit of money to start, because anytime you start a business, even if you go start a little coffee shop, you got to be able to buy your first set of coffee, right? You got to go and get some coffee so that you can start grinding it up and selling cups of coffee. You got to buy some cups. You got to buy some lids. You got to buy some straws. You got to buy some flavoring for your coffee. You got to put some sugar in there. There's things you have to start a coffee shop. Well, if we're going to start a little business in the stock market, we got to have some money to start our business with. So it does take a little seed money, but we can start small and take the profits that we make and just put them right back in and keep putting them back in and keep building our coffee shop or our little toy store bigger and bigger and bigger and bigger. Okay. And the whole main name of the game is that most of us have some sort of an income. If you're retired, you have a Social Security, or you have a pension, or you have disability, or if you're young, you have a job, right? Yeah, some of us have jobs. And so you have a job, and then you're going to have a little bit of income. And what everybody always says, well, I'm just not making ends meet. If I just had a little bit extra, I'd be doing good. I just an extra $100 a month, an extra $500 a month, extra $1,000 a month. I'd be so much better if I could just get an extra little bit. So that's our first goal. Our first goal is to just help you make ends meet, all right? Get a little bit of money coming in, but we also want you to build your business. So we don't want you to take all the money out. You take some out, try and help make ends meet. We want you to put some back in so we can keep building your business a little bit bigger. Then when it gets a little bit bigger, now you can start taking a little bit more out, a little bit more out, a little bit more out, all right? But we're going to take profits along the way. That's what it's called, all right? We're going to show you how this is done. We're going to take profits along the way so that we don't have to wait 30 years to just wait until the market went up a long ways and then start taking it out, all right? So that's how we're going to do this. And so now we're going to come back over and I'm going to show you a couple of other things very quickly. Again, we're going to come back over to the daily chart. I'm going to bring the S&P 500 back down to the daily chart. And we're going to come in and we're going to pull up the Dow. Remember last night we talked about the Dow, DOW 30, Dow 30. How many stocks does the Dow 30 have in it? DIA is the symbol, DIA. What color is George Washington's white horse? Right? So the Dow 30 has 30 stocks. And so the symbol is DIA. There's the Dow. If you want to invest in the Dow, the top 30 stocks of the Dow Industrial Averages, that's what you're going to be investing in. So you come in here and you say, well, I want to buy the Dow. I want to own some Dow. So you come in here and you say, how many do you want to own? You put the quantity in here. Let's say we want to buy 25 shares. That's going to calculate the amount for you right there. It says it's going to cost you $12,000 or $122,000. No, that's $12,000. $12,230 for $489 a share. You want 25 shares. You hit buy market. There you go. You now have the Dow. If the Dow goes up, you make money. If the Dow goes down, you lose money. That's how it works. So you're like, well, wait a second, Lan. Why don't I buy when it's down here? And why don't I sell it when it's up here? Because if I buy it up here and I sell it down here, I'll lose money. Oh, wow. That's a good idea. Hey, that's a good idea. Where did we buy? It's pretty high right now. Could go up, but it could go down. It's kind of neutral. It's kind of halfway. It kind of went up, then came back down. Hasn't gone down very far. The bars aren't red, are they? Maybe we should wait for some red bars. Well, maybe we should wait for some red bars, in this case, to turn into the yellow bars. Let's get rid of that tool. And we'll just go it like that, real simple. Maybe we should wait until we get to the bottom of a red trend, and when it turns green, I got an idea. Why don't we buy it right there instead of just randomly coming in here and saying, well, today's a good day. I think I'll buy some Dow. Why don't we time our entries a little bit? Okay, it's called timing the entries. A lot of people say the most important thing is time in the market. Well, I think one of the most important things is timing the market. Timing the market is as important to me as time in the market, because you can be time in the market, right? If we come back here, I can show you time in the market. We come back to the, what do we say, Microsoft? Here's time in the market right here. You bought in right here and it's right here. Well, you were in the market for a long time. You still lost money. So time in the market, yes, time heals all wounds if you've got 30 years to wait for the market to go up. But timing the market is as important as time in the market. So a lot of what we do in these markets is trying to time when the best time is to get into the market. And we have lots of models that we use to help us determine that. One of them is a very simple model. Hey, it's going from red. Let's turn off the yellow again, because yellow is neutral in this situation. So if it goes yellow, that's neutral. It doesn't necessarily mean buy. So we go from yellow to green. That's a little bit better, a stronger buy signal, okay? But just to make it simple and not complicate things today, we're just going to go red to green. So now what we do is we come down here and we say, hey, it's going from red to green right here. I think I'll buy at the red to green. That's called timing. We're going to time the market. And there's all kinds of mathematical models, indicators, and things that we can add to our software that can help us time the market, right? You've seen all these little indicators and stuff that lay down underneath the chart. Well, we're going to talk about all those. We're going to talk about how they work and how they help us make decisions on when it's time to get into the market. So in my opinion, timing the market is as important as time in the market. So that's how we're going to do it. We're going to do a lot of timing of the market. All right. So we're going to come in and we're going to look at these different charts, and we're going to time when it's time to get into Apple. Now, Apple will probably turn around and go back up. It's gone up. Look at this. It's gone up 1 Viagra, 2 Viagras, 3 Viagras, 4, 5 Viagras. Okay. It's had 5 nice big runs, and it's had 2 little runs down here, right? 1 Viagra down, 1 Viagra back, right? No, these are not Viagra's. What make these are bad? let's abandon that analogy. All right, this market is coming down. Okay, so what we're going to do is we're going to wait for it to come down. How far is it going to come down before it turns around and starts to go back up again? That's the real question, isn't it? That's what we want to know. And so that's what we're going to be learning in our upcoming classes. We're going to talk about timing the market, how to get in, when's the best time to be getting into these markets, and how to take profits along the way when it is going up. All right, when the market's going up, 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 up and away like Superman, then we want to be making that money and taking that money. Because if you just keep buying, that's called dollar cost averaging. You end up with a average price way up here, because you bought here, 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 bought here, bought here, bought here, bought here, bought. You buy, and then you take all the averages of how many buys, and it gives you an average price, right? And you end up with probably an average cost to your shares way up here. And then the market only has to go that far, and you've lost all your money. So buying all the way up an uptrend is not a good idea. Believe it or not, as much as you want to do it and as much as you think it's a good idea, unless you're smart enough to sell when it's up there. If you sell out right up here and you bought all the way up, well, then it is a good idea. But if you're going to buy, and then you're going to hold, you're going to really lose a lot of money, or you're going to have to sit for months and months and months, maybe years, to get it all the way back to where your average price was. So sometimes retail traders, which is what we are, we're retail traders, right? We lose a lot of money on big uptrends. You think that's the biggest opportunity of a lifetime. It is if you know how to trade. But most retail traders will lose all their money on that trend right there. That's where they lose all their money. Okay? So there's things you have to learn. There's strategies that we have to know, and there's ways of trading so that you can take money along the way so that you don't lose it when it starts to come back down, because markets like to make these different patterns, and these recurring price patterns are what's in the manual. So I gave you the manual last night, and you guys all have the manual, and here's the manual. You have the electronic version. It's called the Fibonacci effect, right? And so this is the manual, and in this manual, as you read down through it, you're going to see that the first few chapters, we start talking about different types of trends like this, right? And we talk about how we're going to count them, and we measure them. And then we come in, and we're going to all talk about this in future classes. All right? And this is how we time the market. We start to time in the market, and then we look at, see how we talked about going from red to green, red to green, red to green. Which ones are good? Which ones are questionable? Which ones are bad? Right? We talk about all this neat stuff. And we're going to help you with all this. All right. That's why I'm here. I'm going to help you with all this stuff. This is all stuff that I learned when I was at the Chicago Board of Trade for 10 years. And this is what they taught me. All right. When I was there. And now I'm here teaching it to you. Okay. So this is how it all works. So this is our manual. And you can see all these different ways of calculating and looking at different markets, different recurring price patterns, mathematical modeling, probabilities. And this is how I trade, and this is how I learn what markets do. And when markets do these certain things, we take actions. It's called decision point trading. All right. So when the market gets to a decision point, then this is where you come in and you decide whether to get in or out of the market. And you run it based on the probabilities of the market rising or falling in price. And we do a little bit better job. And you don't have to be perfect at it, because look, the original thought was, well, we just throw our money into it and sit on it for 6 months or 6 years, right? Or 30 years. So if we can do just a little bit better than that, then we're doing better off than what we would have if we'd have just thrown money into the market as if it was a basket of money that you throw into, and then you come back in 30 years and take some out. So if we can time the market just a little bit better, we're doing better than that, right? So you don't even have to be perfect at it. You just have to be a little bit better than just throwing your money at the market and hope something sticks to the wall. So that's what this is all about. It looks complicated right now as you go down through it. You're like, oh my gosh, this is really hard. No, it's not. This is really simple. Remember, I told you, traders are not the brightest guys, all right? Red means down. Green means up. Things like that, right? So we have to have things really simple made for us because we're really simple people. So once you understand the concepts and what you see what we're doing, it's not hard, okay? You can do this, I promise. And I'm here to help you. I'm going to be here to help you. Even after class is over, I'm still going to be here. And I'm still going to help you, all right? All right, so that is the manual. This is the free software. This is the paid software. And we're going to look at a couple more. We're going to look at the, I want to go out and I want to show you a couple of ETFs, because ETFs, remember, exchange traded funds, just a basket of stocks, and big banks and big hedge funds have been out here doing this for a while. ETFs have been around for a while. And so they've started to create lots of ETFs or baskets of stocks that you can put your money into without having to build your own portfolio. So you really don't have to build your own portfolio anymore nowadays, because you don't have to go out and buy individual single stocks, because everything's been built into little portfolios for you. All you have to do is invest in these little portfolios, and then you've got a basket of stocks. So we've got one basket of stocks, which is called MAGS, M-A-G-S, all right? And if you go into MAGS, that's an ETF, an exchange traded fund. And guess what's in MAGS? They call it the Magnificent Seven. So it's got, let's see if we can name them. It's got Apple, Amazon, Netflix, Tesla, NVIDIA, Facebook, which is Meta. What's that last one hanging out there? You know what? We got this really cool tool that I love, and I think you should all really become very familiar with AI, because AI can be some of the greatest help for you when it comes to trading. So this one is Grok, and I really like Grok. You could use ChatGPT, or you could use the Google version, which is, what's it called? It's called Gemini. I've got that one. I've got all three of them. I pay for all three of them. I've got Gemini, I've got Grok, and I've got ChatGPT. So if you don't have any of them, you can get some of them for free, but you can always come and ask me in these classes, and I can help you. But we can come in here and we can say, hey, look, and you talk to Grok, right? You know how to use AI. You talk to it just like it's a person, so you don't have to know anything special. You just come in and say, hey, Grok, guess what? I was in a class at the university, and they were talking about the S&P 500, right? And you say something like, he told me this thing called an ETF. And he said that the S&P 500 was made up of a bunch of other ETFs. Something like maybe 12 ETFs or something like that. What are those ETF stock, ETF, yeah, we'll call them, we'll say stocks, because they're not stocks. We're going stock symbols. Kirk just said that the last one that the pinky one that we forgot was Microsoft for the 7. All right. So if you want to know something, you can just come and ask Grok, and you don't even have to be smart about how you ask it. Like this, I just wrote out this little paragraph. I'm not really sure what this guy at the university was telling me. He was telling me something about the S&P 500, and he said that it's made up of a bunch of ETFs, like 12 ETFs or something. What are the stock symbols for that? And so you can come in here and you just hit the little go button, and Grok's going to go out, and I've got him set on deep thinking, so he's going to probably think for a few minutes. I probably should have told him just to give us a quick answer, because this is easy. This is an easy answer for Grok. He doesn't need to think very long for this one. But we're going to come in here, and we're going to slide that over there while Grok's thinking, because he's going to think. Oh, there it is. He's back already. All right. He says, hey, Lan, it sounds like the professor was referring to the S&P 500's division into 11 key sectors. Not exactly 12, but close, maybe a minor mix-up. Each represented by a popular selector sector SPDR ETF. These ETFs track the performance of stocks within the represented S&P 500 sector, and together they essentially cover the entire index. Here's a breakdown, and there's your 12 different sectors of the S&P 500. So the S&P 500 again has 500 stocks in it, and the 500 stocks are broken down into sectors. So each sector has its own ETF. That's really cool, right? I mean, if you don't want to go out and say, well, I want to buy all the communication sectors, you can just come in here, and the S&P 500 has already done all the work for you. They've picked all the very best stocks within the communication sector, and they put them into an ETF for you called the XLC. That's awesome. What about energy? Oh, I'm really into energy. I've been doing this research into energy. I really wish I could buy some energy stocks. Well, all the very best energy stocks have already been picked by the S&P 500, put into the S&P 500, and they've put into a single ETF, exchange traded fund, or basket, right, called the XLE, and that's just energy. Oh, that's really cool. So what we're going to do is we're going to come in here, slide this off the screen. Now I can still see it. You can't. But I'm going to come over here. I'm going to create a new portfolio, and we're going to call it the ETF. Let's call it the S&P 500 ETF sector portfolio. Sectors. We'll give it an S. There we go. All right, so now we got a new portfolio. We can come in here and we can type in all of these symbols. So we're going to come in, and I'm just going to type them real fast. XLC, XLY, XLP, XLE, XLF, XLV, XLI, XLK, XLB, XLRE, XLU. Now you'll notice I just typed all those in that little string right there, separated by commas. Now if I didn't make a spelling error, I'm going to hit open symbol, and it'll open up all 12 or all 11 of those little sector symbols. All right. That's one of the advantages of having a real trading platform as opposed to some silly program that's free on the internet. It's just one of the other features that allows you to save all this information. So you go and do all this work and all this research, you save it in your platform. All right. You come back tomorrow and it's all still here. Can't do that on the free one out on the internet. All right. All right. So we're going to come in here, and we're going to have this little sector. This is the XLU sector. And it's, well, let's come up and start at the top. This is the material sector. Oh my gosh, look at that one. Woo, materials are doing well. Well, Len, what stocks are in the materials? Well, I got an idea. Let's just ask Grok. Hey, Grok. Hey, Grok. What stocks and their symbols make up the materials sector ETF? And we're going to just put in here X materials is XLB. All right. So we'll just ask Grok, and he can tell us. He'll tell us all the stocks that are in that ETF basket. Now he's going to go do a little bit of work here. Shouldn't take him too long. XLRB includes key stocks, and it's going to go find all the key stocks in there. I'm going to set that off to the side here for a second. We'll go look at another one while he's working over there. He's going to tell us all of the stocks that make up the XLB basket of stocks. All right. So we come down here, we'll look at XLC. That's communications. Look at communications. It's kind of tumbling right now. How about the XLE? Oh my goodness, look at that one. That energy sector is going to the moon. Woo! We might want to invest in that one. It's only $48 a share. What about XLF? Oh, it's going down. You know what? When it's going down, that's an opportunity for us to buy low, right? If it's going up, well, we missed the boat. We don't want to be buying that one. It's really hard strategy to buy high and sell higher. Doesn't mean you can't do it. You certainly can. You can try it. But I've had much better luck buying low, selling high, all right, than trying to buy high and sell higher. Just two different ways of thinking about the market. You can do either one. Which one's right, Lan? Well, which one's right is going to be the one that you have the most success with. I have the most success with buying low, selling high. You might have success buying high and selling higher. Is there a right and a wrong? Nope. There's just a different. It's different. It's not right. It's not wrong. And you never know until after you've done it. You can always say in hindsight, oh, if I would have done this, I'd be rich beyond my wildest dreams. Everybody can do that. But what are you going to do today? What are you going to do right now? For me, it's easier to buy low and sell high than it is to buy high and sell higher. Because if I buy high, I oftentimes don't want to sell higher because it didn't go up very much further than what I bought it when it was already high, right? Because when you buy high, oftentimes what happens, you buy high thinking that it's going to go higher, and it doesn't. So that's a hard one. But that doesn't mean that when it goes low, you can't buy low and then have it go lower, because it can certainly do that too. But if we buy low and it goes lower, we can buy another one down here when it's lower, and we go dollar cost average, and our dollar cost average actually comes down, right? Not up. If you buy high and then it comes down, and then you buy high again, and you keep buying high, your dollar cost average goes up, and then when the market comes, ooh, you lose really bad. That's why I say don't do that. All right, don't do that. All right, I've never had good luck doing that. I've always made more money buying low and then selling high than buying high and selling higher. All right, Croc's still working over there. I should have just told him to do the quick answer. All right, so let's go to the next one, XLI. And I'm going to show you another little short trick. I mean, you can come and ask Grok, and he should have been faster at trying to figure this out. It's not like I'm asking him a hard question. So he's still thinking over there on how many stocks make up the material sector. So we got Spider Sector Fund over here. This is XLI, and this is the industrials. So you can see the industrials. That's kind of cool, right? Now, some of you might be looking and saying, hey, Land's got these cool little indicators turned on here. I can see where there's some buy zones in here. Like right there. See that? That's if I had have bought right there, that'd have been a good place to buy. You're right. Look, if you'd have bought right there, that'd have probably been a good place to buy. This one, not so much. Not so much. Maybe a little bit here, but kind of not really so much. Oh, this one would have been good. Gone up after that one. Oh, what about that one? Well, not so much. But you can start to see, just start getting a little picture of how some of these tools that we're using that are on the screen accidentally here, because I keep leaving them on, start to work. All right. There's another one. There's the technology firm, technology sector. So if you want to know what's in the technology sector, then you can, or just want to invest in the technology sector, that would be kind of like MAGS, right? MAGS. That's just the technology sector. But here's another one, XLK. So you can go and look at the individuals. And Grok's finally done his research, and here he's come up and told us these are the stocks that make up the S&P's XLB, which is this one right here, XLB. All the individual stocks in that basket of stocks. So in that basket of stocks, they've picked these. So there's Albemarle Corporation, there's Amcor, there's Air Products, there's Avery, Ball Corporation, et cetera, et cetera, et cetera. So this is the list of all the stocks that make up that one ETF. And so if we come in here, if you wanted to, you could, now let's just have Grok do it, okay? You could type in all of these and you'd have all the stocks that make up the one material sector. So we can come in here and we're just going to have Grok do it. We'll just say, hey, Grok. And you don't have to really say, hey, Grok. He knows that you're talking to him, but it's kind of fun here as an example, right? Really, all you have to do is just tell him what to do. Put the symbols in a comma separated list. Go. All right. I hope it doesn't take him forever. I should just hit quick answer. Come on, buddy. User wants to put the stock symbols in a comma separate. Come on, buddy. These guy got him down here on expert. I should have turned expert off. Okay, there we go. So he's done it for us. He's put them in there. We're going to grab that real quick right there. Just highlight them, hit copy, come back over here, and I'm going to go into the watch list this time. I'm not going to open up every chart. I'm just going to come into the watch list. I'm going to create a new watch list, and we're going to call it XLB. All right, this is the XLB S&P 500 materials sector. All right, so we're going to do that, and we're going to just drop them right in here. Control V to paste, hit add to watch list, and there they all are. Put them all right in there, and it's going to go out and find out if they're all up or down today. Oh, look, lots of green. That's good. Green is good. That means they're going up. Red is, not so good. That's going down. Unless, of course, you short the market. If you short the market, you like red. So this is the S&P material sector. These are all the stocks in the material sector, and you can see, and you can sort them. Click that little header right there, and it shows you, oh, that one right there, STLD, is up 4% today. So we can double click on that, and it'll open it up over here in our charts. Problem is, it'll open it up into this same portfolio. So we could come in here and create a new portfolio, call it the materials sector, and we're going to say, okay. So we open up this portfolio. Now when we come over here, we can open up just the ones in the materials sector that we want to see. And there, now we got just STLD in our materials sector portfolio. See that? So it's way fancy, way easy to organize everything. And that's our big 4% rally in that STLD. And this thing's gone way up, right? 1 Superman, 2 Supermans, 3 Supermans, 4 Supermans. I'm going to merge those 2 Supermans together. And we're going to go, this is 1 Superman. Ugh. I don't really want that. Almost looks like 1 whole Superman right there. 2 Supermans. We usually get 3 Supermans in a row. All right. 3 drives. Drive 1, drive 2, drive 3. It's called an Elliott wave. All right. So we generally get 3 of those in a row, but we got a couple of breaks in here, so it's kind of being a little funny. But I think we're going to get 1 more drive here, which is what we're getting here, right? We're getting a little break in here. So right there, that's our little buy signal, right? It was a broke there. Now it's up today. So we might see this thing rise a little bit, and we could say, well, how far did it rise last time? Well, last time it rose from here to here, $2,000. So if it goes from here to here, we go $2,000. We say, well, if it goes $2,000, we'd have a target right up here. And we say, well, if it does the same thing it did last time, that's where we can maybe anticipate this price going. That's called probabilities. And we just say, well, is it worth betting on? Sure. Go ahead. This is buying low. Anticipate one more drive. 1 Superman, 2 Supermans, 3 Supermans. There we go. All right, so we come back to our watch list. That's STLD. We can say, well, we're still looking at the materials sector. Let's come in and look at ALB. So we double click that one. It opens up. Oh my gosh, look at this market. Holy cow, that's amazing. An amazing market. It's way high. Where was I back here? Why wasn't I watching the SLB back in those days, right? Right. So you want a little dip and then you want to watch it go. Let's go look at another one. Let's go over here and we'll go LYB. So see, so to figure out the stocks that you might want to trade in, the individual stocks, you can come in and do this type of research, and you can organize it in your platform, and you can trade individual stocks like this. All right, this is how you do your research. Now, first of all, we're only trading what's within the S&P 500. What's the S&P 500? Somebody else has already done all the hard work for us, gone out and looked at the thousands and thousands and thousands of stocks, the 15,000 or more stocks that are out in the stock market, and they've said these are the 500 best. So now out of that, you don't have to go do all that research. You don't have to go out there and look at all of them. Somebody's already done all that hard work for you. They put them into the 500 best, right? Now you can go in and just look through the 500. And you don't even have to go through the 500 because you've got a portfolio here where you can come in and say, what did we call it? We called it the YouTube portfolio, didn't we? YouTube one class. Oh, that was something else. Yeah, now I got so many portfolios in here. Now my portfolios are getting confusing. Material sector. Here's our material sector. So you can come in and you can organize your stocks, and the research has already been done for you. Now all you have to do is just come through and pick which ones you want to trade. Okay, so that's a nice way of being able to organize your thoughts. Already have somebody else do the hard work of pick the best 500. Now you can go into your favorite sector. Do I have did we do S&P 500 ETF sectors? There it is. So you can come in and say, well, my favorite sector, Lan, is healthcare. I really like healthcare. I'm a nurse, and so I know all about that. So I'm going to come and look at the healthcare sector. And we can then go ask Grok to tell us which ones are the individual stocks in the healthcare sector. We can come in, create the watch list, and then we can go down through the healthcare sector and just look at the ones in the healthcare sector and just kind of maybe invest in an area that we have a little bit of knowledge. You can do that too. All right. Kirk saying, ask the sector weighting. I'll let you do that, Kirk, because that's going to take a little bit more time and effort and energy. I'll give you you can ask Grok to do that, or we can do it a little bit later after class or something. Kind of running out of time right now. And I wanted to come in and I wanted to show you another way that you can figure out. In fact, this might show us the sectors. Hold on. I got something for you, Kirk. Let's go do this. We're going to come over and we're going to go let's look at the technology sector, because that's a favorite. This is all this is kind of like MAGS, which has the Magnificent Seven. This is the XLK. So what if we wanted to know what was in XLK? And Kirk's asking a good question. What's the weighting? Remember in class last night, we talked about these different markets and how some of them are weighted more heavily than others. Like they like Apple a lot, so they buy more Apple in these S&Ps. Remember we talked about that in class last night. So the weighting, so we're going to come over, and I think this little program right here, we can come down and we can go to XL. What was it? Oh, forgot. XLK is the technology. So we're going to go look at XLK. We're going to pull it up in this little program, XLK. And one of the nice things about this little FinViz is it does have more of the fundamental stuff than your trading platform. All right. So we come down here and it tells you what it is. And there's the weighting. There you go, Kirk. There's your answer. So we pulled up XLK in FinViz. This is the XLK price stock. And then we slide down here to the fundamental section and it shows you the holdings. And there they are. So in XLK, 14.47% of it is NVIDIA. 12% is Apple. 11.3% is Microsoft. 5.2% is Broadcom. Now, it's got a lot of them in here, so you can hit Show All, and it's going to give you a list. So this is all the stocks, all the technology stocks in the S&P 500 that fall under this one category of technology. So these are all the technology firms, and you can see some of them down here have very tiny little amounts. Like Skyworks is only in here to 0.7. SSI, U.S. government money market, some of these are not. These are just some stabilizers, but they're just real small. It's where they put the money if they don't know where to put it. So the way you got Zebra Technologies in here at 0.11%, EPAM down here at 0.10%. So you can see the big ones are up here. These are the ones that are going to move the market the most. So you got, down here, you got Intel down here at 2% of this particular fund within the S&P 500. So that's a nice way to see it, Kirk. That answers your question and also shows you a place you can come and look for these without having to ask Grok. But Grok can show you too. And then Grok can take them and put them into a format that you can import into your trading platform. So if you want to do it, you can have Grok put them into comma separated, and you can bring them in here and put them into your watch list or put them into your charting program and open up all the charts. All right. So you can drill down into these things just as far as you want to go. Look at that one. That one is the consumer staples. Oh, people are buying things. All right. Consumer staples. All right. So we got, what's that one? We got to go, the name on that one's really wide. Oh, that's real estate. So you can see the real estate business. That's that one. This is utilities. Utilities going down. All right. So we got healthcare. Healthcare is going up. Consumer discretion. This is playtime. Well, people are playing, spending money. All right, guys, that's it. That's what I got for you today. That's just a quick. Oh, we wanted to go, actually, I wanted to show you two more. Before we run off, let's come back to the indexes. Oh, I got lots of things in here that I've added to the indexes. We got another. Did I show you the Dow? I did. I showed you the Dow, right? So I showed you the Dow 30. Oh, we already talked about them. So those are the different indexes. And then the SPY, the Dow, the Russell 2000, and the QQQ. The QQQ. All right, that's the NASDAQ. All right, and then you can see I've done lots of drawings and mathematical modeling onto this one here, which is why I decided to take a short position off of this one yesterday. And so it's down again today. So I didn't really take a short position. I just hedged my position. So I didn't take as much risk as it sounds like I did. I say I put $250,000 in there, $250,000. I did, but I did it as a hedge. I didn't do it as a purchase. So it is a purchase, but it's a hedge purchase. So it's a little bit different. The risk is different. And we're going to talk about that in a future class and show you how that's done and how I did it. All right. All right, guys. Hopefully I've answered your questions. And if you have any other questions, please let me know. You have my email address. You can sign up for my office hours and we can talk. And we will meet again at the university tomorrow night. And we're going to continue our conversation. All right. We're just getting started. We got so much more to share. And we're going to teach you how to do this and make this work for you. All right. And I'm going to help you. So let's do it together. All right, guys. That's all I got for you today. We will see you tomorrow evening.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.